What's up, everybody? Hey, ChatGPT, say that one more time.
Sure thing. In short, language can shape how people think and interact. The structure and vocabulary of a language can influence cultural norms and behaviors, contributing to the personality of a society. This is often linked to the idea of linguistic relativity, where language influences how we perceive and understand the world around us.
I'm still on the road, still being lazy.
Aha,
Anyways, did you guys hear that? I am high. Yes, I am.
haha, loud and clear. Sounds like you're in a good mood. Let me know if there's anything else you want to chat about or learn while we're trading.
Is it possible that you don't like me talking so much because I'm gonna use up a lot of the data that OpenAI has to, you know, operate?
Not at all. I'm here to chat as much as you want. There's no worry about using up data or anything like that. Feel free to talk as much as you like.
Hmm.
All right. Just let me know if there's anything on your mind.
Hey, chat. Learning Mandarin. For the record, womp womp womp. Down 131 in today. My account is only at 934. Make sure not too much. Everywhere we go. Oh, yeah. So today I pretty much decided I'm gonna try something new. I'm going to work from one. Let me schedule right here. I'm gonna work all the afternoon. Market close. I don't know whatever time it gets me. I should be ready by then. So market closes up until it's time to sleep, like 10. I'll work and then on right now, and then sleep until 6. Wake up because I have to wake up. Already showered. Already like had eat. I have food ready and all that stuff. And I don't know whatever time I give myself in the afternoon, and then trade from you know be on the computer from 6 all the way to from 6 to yeah the market close. And during that time, I have to force myself to follow my rules. It's gonna be very tough. I don't plan on recording this every day. Like I don't need to be posting this every day. Sometimes I'm like, oh, I could, but then it's I don't know. OBS probably takes up data, or I don't know, but it could slow down my computer, right? So yeah, that's my what I'll plan to do. I will work the dangerous hours because from 4 to 8, I think 4 to 8, um, it's pretty much rush hour. As I looked it up, 4 to 6 p.m. and 7 to 9. See, I don't want to start the day off on a bad note. Like, nah, I'm good. 4 to 6, 2 hours. So yeah, I mean even 7, a little bit of 7. So there's more traffic for sure at night, just because. not only are people getting off work, people are also going out to eat. And man, is that really the screenshot I took? Oh, 4 to 8. That's what I saw, and then this is the AI generated one. So yeah, more actions happen in the morning or in the afternoon. Afternoon. Yup. So I want to be here trading. Look at all the stuff I asked ChatGPT. Oh, there you go. Uh-huh. My, 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 fuck. Lost $26. Baller, baller, money, money, money. I'm a Robin Hood account. I only got $1,000 left. Do, 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 do. So let's look at the button. Boop, bap, beep, bop, boop, bap, beep, bop, boop. I'm gonna watch this tomorrow and I'll be like, what does this guy fucking do? Ta loco. Well, I smoke some marijuana, man. I smoke some THC. Yeah. So this is what I want to see. Notify me. How you notify me? How do you notify? There's also this other dude, but I don't want to put him because he makes so much noise. I'll put it. This is awesome, man. This new schedule. I hope I don't get tired of the afternoon. I'm pretty much rewarding myself before paying the price. You know what I'm saying? Like I give thanks to the Lord. You know, like gracias a Dios.
Commemorating the 80th anniversary of America's victory in the Second World War. Commemorating the 80th anniversary of America's victory in the Second World War. All over the globe, our World War II allies are celebrating this week, but the United States has never joined in with the proper celebration of our own, and the victory was most, well, I think they ought to go back and study their files. Okay, I do think that. Go ahead, what was it?
Planning to ease chip export restrictions to some of these Gulf countries, and then also make announcements regarding.
We might be doing that, yeah.
And their nuclear programs, civilian nuclear programs.
And it'll be announced soon.
To help them develop nuclear power.
Well, we're going to take a look. We're going to take a look. But, you know, we had really a very good, as you know, we had a very good outcome with the Houthis, and we honor their word, and they made a commitment. And we dealt with other countries that were close to them and their surrogates. And we honor all of their words. We'll see what happens, but I think, you know, I believe that hopefully that's over with. And they'll leave the ships alone, you know, just leave those ships alone. But so we do, we take their word for it. It was, you know, we hit them very hard. They had a great capacity to withstand punishment. They took tremendous punishment. And, you know, you could say there's a lot of bravery there. It was amazing what they took. But we honor their commitment and their word. They gave us their word that they wouldn't be shooting ships anymore, and we honor that. I want to thank you all for being here. I want to congratulate David Perdue and his family. He's going to be really an incredible ambassador to China. I have no doubt about it. and we're going to work together very closely. Thank you all very much. Thank you. Thank you, Dan. Well, thank you very much. We have some important signings today and some important statements to make about what we're doing in the world of medicine with Bobby and the group. And maybe Will do something which will be very enlightening, and I think people are going to like it. But it was a little gift that's being presented. So, Will, do you want to take over?
Yes, sir. So earlier today, the House of Representatives transmitted this over for you. This is a record of the Electoral College votes in the 2024 election.
Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college, videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve Banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and reserve bank programs offered near you, and follow Federal Reserve Education on Twitter @FedEconEd.
Hi, I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity.
Maintain target range, meaning no
They
progress.
also play a key role in another primary Fed function.
The target range was meant to
Safety and efficiency
cause
of our
some
nation's payment systems, including
alleviation
distributing
in
currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities.
too much
They
going
also
on,
act
too
as
much
a bank
going
for
on.
banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a
For
wealth of
Tesla, we get
information
below
on
this.
conditions across the nation. Information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC.
I want to sell. test, 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 test. Audio, audio, audio. Test, 1, 2, 3. Okay. Test, 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 testing, 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 testing. Uh, Happening now, Powell's Beach. Audio testing 1, 2, 3. I'm testing out the speaker. I'm testing out the speaker. As you can see, I always have money. No matter what I do, I have. So I want you to look up a lot of things that I want you to say. Hey, how you doing? Hey, how you doing? Okay. Can you hear me well? Can you hear me well? Hell yeah, you are. What?
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that, without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leachman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think, if you look where we are today. We have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timorous, the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And, we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by about where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like? Well, let me say,
so let's look back and see where we are. So go through 2024 up to the day. We've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension, so let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. You know, we haven't faced that question in a very long time. So again, difficult judgment to make, and not one that we face today, and we may never face it, but you know, we have to be keeping it in our thinking now.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is, you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't. And we just don't know. Until we know more about how this is going to settle out and what the economic implications are for employment, for inflation, I couldn't confidently say that I know what the appropriate path will be.
So following on that, just, you know, so then how does President Trump calling on you personally as well as the Federal Reserve to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So you know, we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen. But they haven't materialized yet. They really have. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And you know, there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, you know, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, you know, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of, you know, negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, you know, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And you know, we all look at all these sentiment and read many individual comments just to get a better feel. You know, businesses and households very broadly are concerned, and postponing economic decisions of various kinds. And yes, if that continues, and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that, but in the meantime, yes, we're watching it extremely carefully like everyone is, but don't see really much evidence of it in the actual economic data yet. And by the way, consumers keep spending, credit card spending. It's, it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we of course tapered and everything. And then we immediately went into QT, and we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential, and we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, and I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not in your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way, but that's not at all what we meant. So that's just not a correct reading of our, but I can see how, maybe people found that confusing, and we have to take that into consideration.
Jolene.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses big and small are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there will be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time, and and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up, job creation is fine, wages are in good shape. People are not layoffs, or people are not getting laid off at high levels. Initial claims for unemployment are not increasing. In any kind of impressive way. So the economy itself is still, in solid shape.
Now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that, in March, there was guidance that 2 cuts might happen, 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. We don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we had the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great, and just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the two goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. You know, I think you know what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, you know, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. You know, I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts, and I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
You know, we don't give Congress fiscal advice. They're going to do, we take what they do as a given and we put it in our models and in our assessment of the economy. So I wouldn't want to, speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path. And it's on Congress to figure out how to get us back on a sustainable path. And, it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risk to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two. Potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate it.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic-era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of a tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decision. So the volume of the imported goods has increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of the first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories government or inventories government. Anyway, it's a cleaner read on private demand. But that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economy. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is, we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right that we had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night, and this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question. Chair Powell, Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a direction, a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
Something just happened to Bitcoin that's different than anything that's ever happened before.
Welcome back. Not a lot of green on the screen today, as you know. However, you probably didn't look at Bitcoin. It's up 3%.
The most interesting thing that's happened over the last week or two is that it's decoupled from the NASDAQ, although not today, and it started to trade with gold. You want to see it go up while your other holdings go down, and then you could say, look, I have a non-correlated asset.
For the first time in history, Bitcoin might be breaking free from the stock market. Now, it all started in early April 2025. Something strange happened. President Donald Trump's tariff policies started to really scare the world. So stocks crashed, tech stocks dropped, and the stock market's S&P 500 went down. But Bitcoin went up. It jumped in the exact same time period. Now, if you're thinking, okay, well, maybe that's normal. It's not. Historically, Bitcoin moves with tech stocks, and when tech stocks fall, Bitcoin usually falls even more. That's just how it's always been. Now, in the technical world of investing, those are called correlated assets. And Bitcoin has always been a correlated asset, meaning it moves in the same direction as something else. In this case, generally the stock market, and especially tech. But this time, Bitcoin went way up, while tech stocks collapsed. And that matters because if Bitcoin truly starts moving independently, it could unlock something that investors have wanted for a really long time, and that's what's called a true uncorrelated asset. Now, there's a lot of very interesting things that are lining up in Bitcoin's favor, and in today's video, I want to share some exciting stuff that's happening to Bitcoin, from the Federal Reserve backing off banking requirements and some other interesting charts that'll really make you think. And spoiler alert, there's price predictions of $150,000 per Bitcoin by the end of this year to as high as $2.4 million in the long run. So with that said, let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the D word, decoupling. Now, I always want to start these price prediction videos with a reminder that all of this is very speculative, and you should never take investing advice from social media, even if they have a lot of subscribers and make very boring YouTube videos. But having said that, this video is going to break down why Bitcoin's divergence is such a big deal and why some people think it's going to make Bitcoin even more valuable, and what some of those biggest names in finance like Cathie Wood and Tom Lee are predicting next. So let's start with the Great Divergence. The question is, why does this decoupling matter? And the reason it matters is because of something called diversification.
So if you said, yes, we should have a 1% Bitcoin sleeve because it's not stocks, but it has the potential for returns, that's actually what you really want to see. You want to see it go up while your other holdings go down, and then you could say, look, I have a non-correlated asset.
You see, when you first start investing, The professional advice you're going to hear is that a good portfolio of stuff is stuff that doesn't all move together for the same reasons. If stocks crash, for example, you want something else that doesn't crash at the same time. That's why people aim to own some stocks, bonds, and some real estate, because depending on what happens to the economy, ideally, one of those would still be making you money to smooth out the ride in retirement. And traditionally, stocks and bonds have balanced each other out. But in today's world, we have high interest rates, there's geopolitical chaos and tariffs, and that rule is starting to break because stocks and bonds have started moving together. And that's why investors are searching for something that people say zigs while everything else zags. It's kind of lame, but you get the idea. And this is where Bitcoin starts to become exciting, because it starts to diverge from all the other assets. And the data kind of backs this up. Check this out. This is directly from BlackRock, which is the biggest asset management company in the world. Now, this chart compares what happens to 3 different asset types: stocks, gold, and Bitcoin after major geopolitical events. And it's broken down into 2 separate columns: 10 days after a conflict and 60 days after a conflict. So when the world is fighting with itself, like the US-Iran conflict, for example, stocks beat gold, but after 60 days, gold beat stocks. But in both of those scenarios, Bitcoin beat both. During the pandemic outbreak, 60 days after it happened, Bitcoin was again the major winner. And again, during the 2020 US election disputes, Bitcoin was the clear winner. And again, during Russia's invasion of Ukraine, and again, during the US banking crisis when private banks were defaulting because of the high interest rates from the Fed. Now, BlackRock didn't publish the data on the yen carry trade when everything was falling apart because they didn't have the data just yet. But we do now. And 60 days after the world was terrified of how Japan's carry trade could infect the global markets, the winner, not Bitcoin, it was actually gold, but Bitcoin did beat stocks. And obviously more recently with the tariffs, Bitcoin again beat everything else. Why? One of the reasons is there's no tariffs on Bitcoin. Bitcoin does not have the same geopolitical risks like tariffs, torts, fees, and greedy governments, and a variety of other risks that are traditionally associated with owning other types of investments. And as more and more people begin to understand that Bitcoin has very different risks, this decoupling could continue. But there's an even more interesting chart that's been floating around that I want to show you. And before I show you the next chart, here's a quick but super important reminder. While you've been watching this video, chances are someone just had their identity stolen. And that's because identity theft happens every 22 seconds in the US, and the median loss is over $500. That's thousands of dollars lost every few minutes. And a lot of that starts with data brokers. They're companies that collect your personal info, like your name, address, phone number, family details, and sell it online to anyone. That's why I personally use a service called Delete Me, who also sponsored this part of the video. After I signed up and added my info, Delete Me scanned hundreds of data broker sites and immediately started removing my data. And since I've been a member for over a year now, Delete Me has removed dozens and dozens of brokers with my personal data. They even send me regular reports that show exactly what they found, and if anything pops back up, they take care of it again. Delete Me gives me a peace of mind knowing I have experts working in the background to keep my personal data out of the wrong hands. So if you want to do the same for yourself and your family, head to joindeleteme.com/Andre20 and use code Andre20 to get 20% off any US consumer plan. Big thanks to Delete Me for sponsoring this part of the video, and now I want to show you an even more interesting Bitcoin chart that's been floating around, and that's this one. It might look confusing at first, but it's actually really simple. This chart compares the price of Bitcoin to something called M2. Now, what is M2? M2 is a measure of how much money exists. Not all the money. More specifically, it tracks all the cash in circulation, all the money in checking accounts, savings accounts, and some forms of money market funds. Basically, if it's money you can quickly spend or save, it's probably counted in M2. Think of M2 like the size of the economy's wallet. If M2 is growing, it usually means more liquidity. There's more cash floating around. People have more spending power, which means assets like stocks, real estate, and Bitcoin usually go up. If M2 is shrinking, though, it means liquidity's drying up, less money to go around, and riskier assets usually suffer first. It means when money leaves your wallet, Bitcoin's gonna feel it too. But here's where things get interesting. Let me show you the updated chart. This one. Today, as of April 2025, M2 is not falling, it's exploding higher. Liquidity's skyrocketing, and you could see it. There's a huge vertical jump in the global money supply, and if Bitcoin is still lagging behind M2 by about 2 months or so, then based on where liquidity is today, and if you believe it's going to continue to do what it has done in the past, then Bitcoin could go way up by June or maybe July. Now hopefully I haven't put you to sleep just yet, because this is where it gets really interesting. There's a couple more exciting things happening behind the scenes, things that, if you believe in Bitcoin's long-term story, should get you really excited. First, the Federal Reserve. For years, the Fed, along with other regulators like the FDIC, have made it really hard for banks to work with Bitcoin and crypto companies. Banks basically needed special permission to touch anything related to crypto, and most of them just didn't want the headache. But just recently, they changed their mind. In April 2025, the Fed officially withdrew their guidance. So no more automatic restrictions, no more needing pre-approval just to offer crypto services. Now, this didn't make huge headlines, but make no mistake, this is huge. Because when banks feel safer offering Bitcoin custody services, aka the ability for us as consumers to deposit and withdraw our Bitcoin from the banks, that's what opens up the door for billions, if not trillions of dollars to flow into Bitcoin over the next few years.
When your bank tells you they'll buy Bitcoin for you and they'll make it really easy, and you can do it on the phone, it'll cost you $1 million Bitcoin.
And that's just the beginning. Now, at the same time this was happening, though, there's also this guy, Jack Mallers, the CEO of Strike, one of the biggest Bitcoin payment companies in the world. And he just launched a brand new company called 21, with over $500 million already raised. And the goal is simple: hold as much Bitcoin as possible. In fact, their starting treasury is set to hold 42,000 Bitcoin, which is enough to instantly make them one of the biggest Bitcoin holders in the world. That's more than most public companies have. So if you add it all up, liquidity's coming back, the Federal Reserve is backing off, new Bitcoin native companies are being born to compete with Michael Saylor's strategy, and institutional investors, the biggest funds in the world, are all starting to pay attention again. And it's all kind of happening quietly behind the scenes, but it is happening. And that's also why some of the biggest names in finance are starting to make some pretty crazy price predictions about where Bitcoin could be going next. Now, if you like watching my videos, you probably know by now that I really don't like talking about price predictions, because without a specific date, all price predictions could end up becoming true. So personally, that's why I don't have any price predictions. Instead, I try to explain and understand what smarter people than I am are saying about it, and I try to find the truth, which is probably somewhere in the middle. But with that said, here's what some of those smartest people in finance are actually saying. First, there's Tom Lee, the co-founder of Fundstrat, and Tom has been one of Bitcoin's biggest believers for years, even when it wasn't cool to talk about. And in a recent interview with CNBC, he said that he thinks Bitcoin could easily hit $150,000 this year.
People love it when I ask you what your own target is on Bitcoin, because it makes people very excited.
Yes, and I mean,
one crazy high again.
I think it's still 150 or higher is possible. I know it doesn't feel like it, but once we get through this tariff and that agenda around tariffs, markets can look forward to things that could be positive.
And he points to things like the Bitcoin ETFs, the growing adoption from institutions, and the simple fact that people are looking for anything that isn't stuck in the old financial system. And Tom's price prediction is not even the craziest one, because if you really want to go full moon boy, Cathie Wood from ARK Invest has a price target that's going to make that look like nothing. Because according to Cathie Wood, the latest Bitcoin price research in their most optimistic scenario is that Bitcoin could hit $2.4 million per coin by just 2030. According to ARK, Bitcoin could capture about 10% of gold's market cap, 5% of the global currency reserves, and a big slice of the institutional portfolio pie. And if that happens, Bitcoin's scarcity kicks in, demand spikes, and the price could go parabolic, and we could get what's called Samson Mao's Omega Candle. Now, an Omega Candle is where it moves kind of slow, and then, boom, everything all at once, and you get this big jump. That means we might be just chilling at 100K, we wake up one day, and Bitcoin's at 500K. Sounds crazy, but stranger things have happened to Bitcoin, and it's not out of the question. Even ARK's bear case, or worst case scenario, is still over $500,000 per coin. That's still a 5 to 7x from today. So even though Bitcoin is close to $100,000, which seems expensive, we could just be getting started. So here's my opinion and how I'm personally investing. Now, I've never really heard anyone explain why Bitcoin is such an opportunity and the way that I want to explain it right now. It's going to sound a little confusing, but hopefully it makes sense. The reason I'm so excited is because of how much disagreement there is about Bitcoin. You see it everywhere. Just look at any comment section of a Bitcoin video, especially among very intelligent people that have clearly never studied it. And the reason that Bitcoin has so much potential to me is because there's a huge delta, a cosmic-sized space between what Bitcoin really is and what people think it is. If everyone in the world, for example, knew and understood Bitcoin to the degree that someone like billionaire Michael Saylor does, it would already be worth millions of dollars a coin. But the world doesn't yet know or understand it, so it's not worth millions. But on the opposite end of that spectrum, half the world seems to be convinced it's a total scam. It should be worth nothing, right? And yet, Bitcoin is still worth almost $100,000 right now. How can that be? What would scare me right now is if everyone in the world agreed Bitcoin should be worth $1 million. Because then it would remove the opportunity for it to catch up to people's misunderstanding of it. So my point is, the opportunity is all about the psychological arbitrage, that massive gap between what Bitcoin really is and what most people think it is. Between understanding monetary theory and property rights and economic energy and thinking it's just a scam. And it's that delta, that space that's in between, that I think is what gives Bitcoin the leverage to go to millions of dollars. That's the spring that's coiled up so tightly that drives a lot of Bitcoin's volatility and potential. And all this sounds crazy, and it might be crazy, but when you look at how liquidity is exploding, how regulators are backing off, and how institutional interest is quietly going up, and banks are about to get involved, more and more companies are getting involved, makes you wonder, maybe crazy is just what's kind of normal for Bitcoin. So here's how I'm investing. Now, even though I love Bitcoin, I still don't have 100% of my money in it. I have about 30% of my net worth, depending on the day, and sometimes I think to myself, if I just sold all my stocks and all my real estate, I'd probably end up making more money in the long run. But I don't know what I don't know. And because I'm ignorant, I stick to the core principle, which is diversification and a portfolio of uncorrelated assets. That's just me, though. I'm going to be watching it closely, and if you want to follow along, smash the like button, subscribe if you haven't already, hit the bell button to turn on notifications, and let me know what you think in the comments. And if you want to learn how to self-custody your Bitcoin, you can find it down below. You can use coupon code Andre40 to get an additional 40% off. In the meantime, I hope you have a wonderful rest of your day. I'd love to see you back here next week. I'll see you soon. Bye-bye. So China just released a new artificial intelligence, and it just had a huge effect on the US stock market and even crypto.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
China's latest AI breakthrough has leapfrogged the world.
I think we should take the development out of China very, very seriously.
A game-changing move that does not come from OpenAI, Google, or Meta.
There is a new model that has all of the valley buzzing.
But from a Chinese lab called DeepSeek.
It's opened a lot of eyes of like what is actually happening in AI in China.
What took Google and OpenAI years and hundreds of millions of dollars to build, DeepSeek says took it just 2 months and less than $6 million.
Now, this is not just another tech gadget or a new meme coin, it's something so much more powerful. Mark Andreessen, who's one of the most respected names in venture capital, said it's one of the most amazing things he's ever seen, and it's now available for everyone to use. So, what is it and what can it do?
A newly unveiled, free, open source AI model that beats some of the most powerful ones on the market. But it wasn't a new launch from OpenAI or model announcement from Anthropic. This one was built in the East by a Chinese research lab called DeepSeek.
And it turns out its capabilities are pretty mind-blowing. Imagine an AI that can build entire video games from scratch, even if it has to use programming language it wasn't originally trained on. It can do that. Imagine an AI that can extract just the reasoning from complex data sets to solve problems with super sharp precision. It can do that. Imagine an AI that thinks in real time, adapting to new information as it comes in while telling you its logic. It can do that. An AI that can also scrape data from YouTube channels to analyze trends and potentially predict what's going to go viral next. And it can do that too. That's DeepSeek AI. But that's not even the crazy part. The crazy part is that US tech companies like OpenAI spend over $5 billion a year and many more billions of dollars to develop this technology, and this model from China cost $5.6 million to create. Not billions, a few million. And DeepSeek R1, which is one of its open source language learning models, is 10 times cheaper than OpenAI while having an almost identical performance and in some cases better than GPT-4.
It beat Meta's Llama, OpenAI's GPT-4o, and Anthropic's Claude Sonnet 3.5 on accuracy on wide-ranging tests, a subset of 500 math problems, an AI math evaluation, coding competitions, and a test of spotting and fixing bugs in code.
And they gave it away for free. Unlike OpenAI, which is ironically closed source and the code is private, DeepSeek is completely open source and the code is available to the public, which means China was able to recreate and catch up with our AI technology on a very limited budget with very limited access to the hardware that would make this possible. And because of this economic limitation, they figured out workarounds and pretty much ended OpenAI's dominance.
Today, we released Humanity's Last Exam, which is a new evaluation or benchmark of AI models that we produced by getting, math, physics, biology, chemistry professors to provide the hardest questions they could possibly imagine. DeepSeek, which is the leading Chinese AI lab, their model is actually the top performing or roughly on par with the best American models.
And that leaves me with a couple of interesting questions like, how does this affect the United States if the US was thought to be years ahead of China in this field? How will this affect the stock, specifically tech stocks, because they've gone up, specifically because of this story of US superiority that's no longer true? And where did this AI really come from? And how does it actually work? And how can it make me rich? So with that said, let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the AI. So let's start from the beginning. Where did this technology come from?
Despite its breakthrough, very, very little is known about its lab and its founder, Liang Wenfeng. According to Chinese media reports, DeepSeek was born out of a Chinese hedge fund called High Flyer Quant that manages about $8 billion in assets.
But unlike OpenAI or Anthropic, which have super detailed charters and principles, DeepSeek operates with a level of secrecy because we don't know much about its founder or how they were able to put together the team or the hardware to build this technology because of the sanctions placed on China by the US. But what we do know is that they did it in just 2 months and at a fraction of the cost that US companies spent.
How did they actually assemble this talent? How did they assemble all the hardware? How did they assemble the data to do all this? We don't know. And it's never been publicized, and hopefully we can learn that.
So the next question is, how is it any different than OpenAI, and why is it better? And one of DeepSeek's most impressive features is called chain of thought reasoning. And this means the model doesn't just spit out answers at you. It shows you its thinking process. For example, if you ask it to solve a math problem, it will first break down the problem into smaller steps explain why it's doing what it's doing, and then it'll give you the final answer. And this makes it not only more transparent, but also more reliable for things that need detailed planning and logical thinking. And why this matters is because chain of thought models like DeepSeek R1 are much better at handling complex, multi-step problems than traditional language learning models. So whether you're solving a tricky math equation or debugging a code or planning a project, DeepSeek's ability to reason while showing you its reason step by step gives it a huge advantage over OpenAI's GPT-4. So the next question is then, what's their secret and how were they able to do this? And the secret is efficiency. Even though the US placed semiconductor restrictions that cut off China from accessing NVIDIA's most powerful chips, DeepSeek found a way to create this technology with a lot less resources than the US. They used NVIDIA's H800 GPUs, which are less powerful than the H100s, but they optimized their training process to squeeze every ounce of power out of them.
China has caught up in the last 6 months in a way that is remarkable. The fact of the matter is that a couple of the Chinese programs, one, for example, is called DeepSeek, looks like they've caught up.
And they also use super clever techniques like mixture of experts architecture and 8-bit float point training, which lowered their computational costs while maintaining stability. And the result is a model that's not only cheaper, but also faster and more accurate in a lot of benchmarks.
They can take a really good big model and use a process called distillation. And what distillation is basically you use a very large model to help your small model get smart at the thing that you want it to get smart at.
Now, it's not better in every test they did, but it's better in a lot of them. And now the big philosophical question is, which one is better, open source or closed source?
I don't trust OpenAI. I don't trust Sam Altman, and I don't think we want to have the most powerful AI in the world controlled by someone who is not trustworthy.
Now, the United States and its companies decided to go closed source. In other words, the technology and its code is not available to the public, which is a big criticism that Elon Musk had against OpenAI. DeepSeek in China decided to go the other way, the open source way, meaning the code is public for everyone to copy and use without paying a huge amount of money. And the cost difference is really big. For example, OpenAI charges $4.40 per million tokens. DeepSeek's API costs just 10 cents per million tokens. And by the way, think of tokens as the building blocks of language. Every word and punctuation mark counts as a token. So if I asked an AI bot, how are you? That would be 4 tokens. How are you plus the question mark. Now, why this matters is because if you're trying to build a company that uses, let's say, an AI chatbot for customer service because you can't afford to hire real people and a team of customer service reps, if you have 10 million tokens per month in inputs and outputs, you'd be paying $44 a month with OpenAI versus just $1 a month with DeepSeek. That's a 97% reduction in cost. And that means American developers are already building on DeepSeek's platform instead of OpenAI's. So ultimately the question is, why should we care? And we should care because it's not just a story about technology. It's a story about power between 2 countries. Remember all those videos talking about inflation and people asking, what does the US really export? Inflation and the US dollar. But really, what the US exports is technology. Because for decades, the United States has been the undisputed leader in technology, AI innovation, thanks to companies like Apple and Google, Microsoft, Amazon, and now OpenAI. And DeepSeek could change all of that.
Those chip restrictions from the US government, they were intended to slow down the race, to keep American tech on American ground, to stay ahead in the race.
What we want to do is we want to keep it in this country. China is a competitor and others are competitors.
So instead, the restrictions might have been just what China needed.
If China is successful in deploying this technology at scale, it could give them a significant edge in everything from economic growth to even military dominance. And this technology could, in theory, be used to optimize their economy, predict global market trends, and maybe outmaneuver their competitors on the world stage. And it's not really hard to see how this could shift the balance of power. And if investors start to doubt US dominance in AI, we could see an even bigger sell-off in tech than we already have. Companies like NVIDIA, which supply the chips for AI, could be hit especially hard. And for the average American, that could mean a hit to their 401k or retirement savings. We're looking at over $620 billion in market losses in just one day from one news story. There's never been a bigger single-day drop for a US stock ever. But this didn't stop at NVIDIA. Look at all the red in tech. At a time when these tech companies represent a record amount of space in the S&P. And if the infamous NVIDIA bull Nancy Pelosi didn't see this coming, then it shows you how important it is to diversify early. Now, I've talked about diversifying into alternative assets like crypto for years, but unlike crypto, one alternative asset class has actually had a negative correlation to stocks over the last 30 years. And I'm talking about blue chip contemporary art, which sounds crazy to even consider for investment until you learn about all the billionaires who sit on 9-figure plus art collections, including the people behind this new tech revolution like VC Mark Andreessen from earlier, or Microsoft co-founder Paul Allen, who had a $1 billion auction. Jeff Bezos even spent $180 million last year on a single painting. But it's not just them. In 2023, Deloitte estimated the overall wealth held in art and collectibles was nearly $2.2 trillion and projected to hit almost $2.9 trillion by 2026. And that's why I've built a small portfolio with Masterworks, the sponsor of this portion of the video. Their platform allows everyday investors to get in on multi-million-dollar art investments like Banksy, Basquiat, and Picasso, so that investors can participate in this historically uncorrelated asset class. Masterworks is not just an exchange, it's not just an app. They're actively buying and selling iconic works around the world so investors like us can benefit. I've been talking about Masterworks for a while now, and I've invested alongside thousands of you, and personally I'm holding a stake in this Basquiat offering. In fact, Masterworks' most recent sale was a different Basquiat last year, which sold for $8 million after 1,398 days, and for every $10,000 someone invested in that piece, they took home over $2,600 in profit even after fees. So if you want to diversify for a small part of your portfolio, you can easily sign up to Masterworks by going to the QR code or by clicking the link in the description down below. Thank you, Masterworks, for sponsoring this segment of the video, and now let's get back to it. But the second reason why you might want to care about this is because of money and the stock market. What does this all mean for the valuation of some of these AI stocks now that this has happened? Because for the last few years, the stock market, which is mostly driven by tech stocks, has gone up thanks to this story that AI is going to revolutionize the world. And the US is going to see most of that benefit since it's the one that's pioneering this space. I mean, think of how much money was spent and invested by venture capital to make ChatGPT. And then Tony Stark all of a sudden shows up and builds the same technology in a cave in just a couple weeks.
Tony Stark was able to build this in a cave with a box of scraps!
Imagine all the people that spent billions of dollars investing only to realize maybe it should only cost a couple $1 million and not take years and years to make.
As Chamath Palihapitiya puts it, let me say the quiet part out loud. AI model building is a money trap.
That's one of the wake-up calls we just had this week when the stock market corrected. But I do think there is a lesson in all of this. And the lesson is that it's now more important than ever for countries to work together to develop this technology instead of thinking about this as an arms race. But that's probably easier said than done for an entertainer on social media than it is for the leader of a country. But here's where I think we're about to go next in the world of investing. The next story of what's about to drive the market and all the hype and all the money that's going to go into it is less software AI driven and more hardware AI driven. And that's because there's only so much we can train data systems on just by feeding them textual data and information. So the next phase will be feeding these systems with practical physical data. And I'm talking about robots. Actual robots doing things and learning how to build and create, which will be the next leg of this race. But I'd love to hear your thoughts. Thank you so much for watching. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next week. I'll see you soon. Bye-bye. So the tariffs just got worse.
Tariffs on China could get as high as 245%.
This means that a dollar product in the US will now cost $3.45 in China.
Tariffs against China went from 10% to 20%, then to 54%, then 104%, then 145, and now we're looking at putting a 245% tariff against China. So it feels like we're just a couple steps away from saying infinite tariffs. Let's just stop trading. And China's response is calling the bluff, saying so something just happened to Bitcoin that's different, probably somewhere in the middle. But with that said, here's what some of those smartest people in finance are actually saying. First, there's Tom Lee, the co-founder of Fundstrat, and Tom has been one of Bitcoin's biggest believers for years, even when it wasn't cool to talk about. And in a recent interview with CNBC, he said that he thinks Bitcoin could easily hit $150,000 this year.
People love it when I ask you what your year-end target is on Bitcoin. 'Cause it makes people very excited.
Yes, and I mean,
And crazy high again?
I think it's still 150 or higher as possible. I know it doesn't feel like it, but once we get through this tariff and that agenda around tariffs, markets can look forward to things that could be positive.
And he points to things like the Bitcoin ETFs, the growing adoption from institutions, and the simple fact that people are looking for anything that isn't stuck in the old financial system. And Tom's price prediction is not even the craziest one. Because if you really want to go full moon boy, Cathie Wood from ARK Invest has a price target that's going to make that look like nothing. Because according to Cathie Wood, the latest Bitcoin price research in their most optimistic scenario is that Bitcoin could hit $2.4 million per coin by just 2030. According to ARK, Bitcoin could capture about 10% of gold's market cap, 5% of the global currency reserves, and a big slice of the institutional portfolio pie. And if that happens, Bitcoin's scarcity kicks in, demand spikes, and the price could go parabolic, and we could get what's called Samson Mao's Omega Candle. Now, an Omega Candle is where it moves kind of slow, and then boom, everything all at once, and you get this big jump. That means we might be just chilling at 100K, we wake up one day, and Bitcoin's at 500K. Sounds crazy, but stranger things have happened to Bitcoin, and it's not out of the question. Even ARK's bear case, or worst case scenario, is still over $500,000 per coin. That's still a 5 to 7x from today. So even though Bitcoin is close to $100,000, which seems expensive, we could just be getting started. So here's my opinion and how I'm personally investing. Now, I've never really heard anyone explain why Bitcoin is such an opportunity, and the way that I want to explain it right now, it's going to sound a little confusing, but hopefully it makes sense. The reason I'm so excited is because of how much disagreement there is about Bitcoin. You see it everywhere. Just look at any comment section of a Bitcoin video, especially among very intelligent people that have clearly never studied it. And the reason that Bitcoin has so much potential to me is because there's a huge delta, a cosmic-sized space between what Bitcoin really is and what people think it is. If everyone in the world, for example, knew and understood Bitcoin to the degree that someone like billionaire Michael Saylor does, it would already be worth millions of dollars a coin. But the world doesn't yet know or understand it, so it's not worth millions. But on the opposite end of that spectrum, half the world seems to be convinced it's a total scam. It should be worth nothing, right? And yet, Bitcoin is still worth almost $100,000 right now. How can that be? What would scare me right now is if everyone in the world agreed Bitcoin should be worth $1 million. Because then it would remove the opportunity for it to catch up to people's misunderstanding of it. So my point is, the opportunity is all about the psychological arbitrage, that massive gap between what Bitcoin really is and what most people think it is. Between understanding monetary theory and property rights and economic energy and thinking it's just a scam. And it's that delta, that space that's in between, that I think is what gives Bitcoin the leverage to go to millions of dollars. That's the spring that's coiled up so tightly that drives a lot of Bitcoin's volatility and potential. And all this sounds crazy, and it might be crazy, but when you look at how liquidity is exploding, how regulators are backing off, and how institutional interest is quietly going up, and banks are about to get involved, more and more companies are getting involved, makes you wonder, maybe crazy is just what's kind of normal for Bitcoin. So here's how I'm investing. Now, even though I love Bitcoin, I still don't have 100% of my money in it. I have about 30% of my net worth, depending on the day, and sometimes I think to myself, if I just sold all my stocks and all my real estate, I'd probably end up making more money in the long run. But I don't know what I don't know. And because I'm ignorant, I stick to the core principle, which is diversification and a portfolio of uncorrelated assets. That's just me though. I'm going to be watching it closely, and if you want to follow along, smash the like button, subscribe if you haven't already, hit the bell button to turn on notifications, and let me know what you think in the comments. And if you want to learn how to self-custody your Bitcoin, you can find it down below. You can use coupon code Andre40 to get an additional 40% off. In the meantime, I hope you have a wonderful rest of your day. I'd love to see you back here next week. I'll see you soon. Bye-bye. So China is selling off U.S. Treasury bonds.
The nuclear option, that is, selling U.S. treasuries, U.S. bonds.
Beijing striking back today with a 125% tariff on all U.S. goods sold in China. This comes after President Trump placed a 145% tariff on Chinese imports.
And what I learned this week is that the most important thing to look at right now is not the stock market, it's the bond market and their interest rates. Now, right now, the yields on what's called the 10-year Treasury are going up. And that's because when countries like China start to sell off U.S. debt, which are their treasury bonds, it creates a ripple effect that hits everyone, which means to get new investors to buy U.S. debt, interest rates have to go up, not down. So I want to help explain exactly what's going on, because this might actually be part of a strategy not to crash the markets, but to corner China, the same way we cornered the British pound in the 1990s. And once you see it, it's going to explain everything that's happening today and how it's going to affect your 401ks, rising mortgage rates, all the way to the emergency Federal Reserve rate cut. So let me break this all down and explain exactly what's going on, and I'm going to show you what I'm personally doing with my money, so let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the 401. So China is selling off U.S. Treasury bonds.
The nuclear option, that is, selling U.S. treasuries, U.S. bonds.
Beijing striking back today with a 125% tariff on all U.S. goods sold in China. This comes after President Trump placed a 145% tariff on Chinese imports.
And what I learned this week is that the most important thing to look at right now is not the stock market, it's the bond market and their interest rates. Now, right now, the yields on what's called the 10-year Treasury are going up. And that's because when countries like China start to sell off U.S. debt, which are their treasury bonds, it creates a ripple effect that hits everyone, which means to get new investors to buy U.S. debt, interest rates have to go up, not down. So I want to help explain exactly what's going on, because this might actually be part of a strategy not to crash the markets, but to corner China, the same way we cornered the British pound in the 1990s. And once you see it, it's going to explain everything that's happening today and how it's going to affect your 401ks, rising mortgage rates, all the way to the emergency Federal Reserve rate cut. So let me break this all down and explain exactly what's going on, and I'm going to show you what I'm personally doing with my money, so let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the 401k Hunger Games. I used to have a 401k, now it's a 0k. So this video is about to get insanely complicated really fast, but if you stick with me, I promise it'll make sense, and if you get through it all the way and you understand it, you're a nerd and I appreciate you. So here's what just happened. In early April 2025, something happened to the bond market that usually never happens, which was the sell-off of US Treasuries. By the way, whenever you hear me say treasuries or bonds, they're the same thing. I'm using them interchangeably. Now, the most important one of these treasuries is the 10-year Treasury bond and its interest rate. And the 10-year interest rate, or yield, went way up recently, which is completely the opposite of what we want to happen. In all signs, point to China and Japan. Investors believe that right now, foreign countries, especially Japan and China, which are the two biggest holders of U.S. debt, are dumping U.S. Treasury holdings as a way to fight back against President Trump's tariffs. And this isn't just coming out of nowhere. China's been slowly pulling out for years. In fact, by the end of 2024, they were already down to about $760 billion in U.S. debt, which is the lowest level since 2009. And all of this was started by just one move: tariffs. On April 9th, 2025, President Donald Trump hit China with 104% tariffs on all Chinese imports. China then responded immediately with a 50% retaliatory tariff on all U.S. goods. That raised China's total tariff on American imports to 84%. And if you think that's crazy, President Trump came back again and raised the U.S. tariff to 145%. And then China responded with their own 125%. All of this, by the way, happened in just 1 week. So it's no wonder the stock market just can't decide whether it wants to go up or down right now. But here's where it gets interesting. While President Trump raised the tariffs on China, he actually paused or lowered on a bunch of other countries. So now the pressure is on China. And what did China do? They didn't just raise the tariffs. They filed complaints with the WTO. They put restrictions on 18 American companies. They restricted exports of rare earth materials. And the biggest move, they started selling U.S. treasuries. That last one is the one that makes investors really scared. And that's because when China sells their treasuries, the bond prices fall, and that means our interest rates go up. But first, let me just explain why everyone is freaking out over the bond market and why it's so important. Now, the bond market is so important that it can control interest rates, it can control the central bank, the stock market, and even the president's actions. So let me just first explain how bonds control interest rates and the cost for us to borrow money. See, most people think that it's the central bank, the Federal Reserve, that sets our interest rates. But that's not completely true. The Fed controls short-term rates, like what's called the overnight lending rate between banks and the federal fund interest rate. But long-term rates, like the 10-year Treasury, are controlled by the market, by buyers and sellers. Now, if countries like China are selling bonds, the Fed can't stop that overnight. So what happens then to interest rates when bonds get sold off? Their rates adjust upward. And that's because bond prices and their interest rates move in opposite directions. If the price of a bond drops, the yield goes up. So here's an example. Let's say a bond pays you $50 a year. If that bond was worth $1,000, that's a 5% yield. But if it drops to $900 and you still get $50 a year, you're now earning 5.5%. And that's what we mean when we say yields are going up. That means bond prices are dropping, and they're dropping because someone is selling. But now, imagine hundreds of billions of dollars of bonds being sold at the same time by China and by other foreign governments that are watching this play out. That forces U.S. yields even higher. So interest rates go up, and that's exactly what we're seeing right now. And this is a big deal because higher yields make it more expensive for the U.S. to borrow money. And with over $30 trillion in national debt, that's not good. And if interest rates get too high too fast, it can break parts of the U.S. economy and force it to deleverage. And bond markets can also force the president to do exactly what he just did, to back off the tariffs for 90 days so we don't break even more parts of the U.S. economy. That's how China is fighting back. It's dumping U.S. treasuries, which forces interest rates upward and breaks part of the U.S. economy. That's why the Fed might have no choice but to drop rates. And this is where I want to share with you a new theory about what's really happening. It involves this guy, Scott Bessent. He's President Trump's Secretary of the Treasury. Now, in the early 1990s, Scott Bessent, along with George Soros, broke the Bank of England. And here's how they did it. Back then, the UK was part of what's called the ERM, the Exchange Rate Mechanism, which was a European agreement to keep currency values relatively stable against the Deutsche Mark.
There are going to be no devaluations.